Okay, so let's go ahead and get started. So yeah, welcome everybody. This is the first one that we ever run online. It looks like, if it's going to be a cool format, we can probably hold even more meetings this way. So we don't always have to rent a space, and hope everybody's staying safe during the lockdown and everything. So today, so it's about 2 months into this shelter in place lockdown. Lots of craziness, especially lately with the riots and everything. But you know, I figured it would be a good time for for me to share kind of like where we see the market as being, and also what has been our experience running the properties under our management, as well as all the other properties that I've invested in. So overall, how is the rental market doing? Okay, cool. So agenda, we'll do a quick introduction of the team. We'll do a market overview of kind of where we are now. It's definitely having a real impact to the rental market. So we'll talk about that, as well as what steps that we and our partners have done to make sure that we can manage the assets efficiently. And finally, we'll close out with an outlook of where we think things will be in the future. So standard disclaimer, we're not brokers, we're not agents or attorneys. All the stuff we talk about here is just for knowledge sharing. So no legal advice, don't sue us. We're not soliciting, we're not selling anything, just for sharing information. If you would like to hear more, would you like to also learn more about our meetups and any questions that you have, feel free to join us at the link multiinvest@gmail.com. Yeah, so we have a periodic email that we send out, so join our mailing list and we'll be notifying you of anything that comes up. So who we are. So Link Multifamily. So Link Multifamily, we're a group of out-of-state investors. We are all within California, in the Bay Area mostly, and we invest in other parts of the country. So we primarily right now focuses on Dallas, Texas, but many of us also have other investments all across the country in different asset classes. So we're pretty diverse. So currently we're managing about 350 units and about $350 million worth of assets. And we raised over $6 million to acquire these assets. So a syndication is basically a team of investors. And by grouping our power together, we're able to take down much larger institutional quality size properties. So, just to recap, a couple of the deals that we have acquired in Dallas. So we acquired a 218 unit Class B in Grapevine, Texas, called Encore. And we also have another 143 units. It's actually 146 now. We actually added 3 more units to the apartment. And that one is in Arlington, Texas. And, so our investors actually have gone and checked out these properties. You're welcome to go drop by and see how they're doing. So investments that you can see and touch. Okay, so a little bit about me. I'm Tony. My name is Tony, and I'm a software engineer primarily by trade. Been in the Valley for about 20 years. Main focus is on cloud computing, and I got into real estate about 17 years ago, and I have investments in China as well as over here. A few years back, I took a serious look at what other investment types are there and decided to start focusing on multifamily. So I'm passively invested in over 3,000 units, also invested in self-storage deals, business acquisitions, and eventually started sponsoring and leading deals of our own. So I'm deal sponsor and key principal on 3 apartment complexes. Dave Lin is on the call as well. And Dave is my partner in crime. So he also has a lot of experience in real estate. Um, he's like the little mayor of Austin. He has like multiple quadplexes there, and then he's acquiring more. So, he's also invested in as a limited partner in a lot of these multifamily deals, probably well over 1,000, 2,000 units as well. Okay. So, I talked about this before, but I'll give a little overview. Why do we choose to invest in apartments versus other type of assets, right? The main thing is, buying single family homes or small, quadplex or duplex, it's hard to scale up your operation, right? So with a group of investors, we're able to buy institutional quality um, deals and, enjoy all the benefits that come with it. So large apartments are extremely downturn resistant, so if you lose a tenant in your house, in your rental home, that's 100% loss of revenue, right? Whereas, if we lose 5 or 10 tenants out of a 200 unit house, apartment, that's only like a 5% drop. You barely feel it, and you can fill it back up pretty quickly. So economy of scale, we buy materials, labor, all the kind of stuff that we purchase are like at a fraction of a cost because we're buying for like 300 units. These materials get shipped to us by the container loads, and we're able to get really, really special pricing on bulk items. So what I probably like the most about apartments is you get a lot of tax savings out of it, right? You're able, all the gains from from the asset, from the value creation aspect of it, it's all taxed as long-term capital gains, right? It's like 15%. And then all of our cash flow that we get out yearly, that's all tax deferred as well because of the bonus depreciation that we can take advantage. So you basically don't pay any tax for your cash flow upfront. So me being a software engineer, I'm super into math. So I really like the fact that I can value these multifamily deals as a business. I can make, I can do a reasonable business projection on, if we do this, how much money cash flow we can generate, what is the appreciation that we can realize, and then you can factor in, mathematically factor in a lot of risk factors. So it's a business. It's absolutely a business, and it can be calculated as such. And finally, it's very rare in commercial assets that you can get such attractive financing. You're able to get loans directly from Fannie Mae or Freddie Mac, and you're able to get like up to 80% leverage, right? And right now the interest rate is probably 3.1 or sometimes even below 3% on the 30-year amortization, right? So rate is locked for 12 years. It's it's non-recourse. They can't come after you if the property underperforms. So it's extremely attractive. So basically what we do is we take over properties where the previous owner haven't run it so well, the rent is below market, and we do very light renovation to it, okay? So this is what a unit would look like before. You see white appliances, really old cabinets, all that kind of stuff, right? So after we renovate it, it'll look like this, right? So okay, we'll talk about that in a second. So after we renovate it, you'll notice that it looks a lot better. The cabinets are really just painted. Okay, so we get that done at about $50, for about $50, $60. Backsplash is $70. Granite countertop, we can get them. Right now we're installing granite, and this is $99 for a slab. And then basically the refrigerators and all that kind of stuff. We get like a refrigerator, stove, and dishwasher. 3 of them, we get them as a package for like only $650. So it's super cheap to renovate this. To renovate this entire unit only run us about 2,500, some maybe about upwards of 3,000. And the work is all done by our in-house staff. So we don't actually pay for any contractor labor fees, etc. So Dan, I saw your question, and we'll cover the loan aspects in a later slide. And yeah, if you guys have any questions, feel free to ask. I like to make this interactive. So any questions before we move on? Okay. So coronavirus. So I don't think I need to repeat all the things you guys have been seeing on the news, about all the impacts to the economy, to people's jobs. The good news is things, for better or worse, things are opening back up, right? So in terms of coronavirus, the biggest concern we always have is about employment, right? And whether or not we're going to hit a second wave now that all the states have some kind of reopening plan, right? Texas in particular is pretty aggressive in reopening. Texas is one of the states that saw the least amount of impact, but then they have a tiered strategy of opening things back up. So as of right now, Texas, already opened up the restaurants for about 25% capacity for like about 3 weeks ago already. So this week, they're actually opening up almost everything. Okay, that includes amusement parks, that includes barber shops, that includes like all the places where you get really close, bars, etc. They're all open. So some of the things that open later, including gyms and stuff, they're about 25% capacity, but restaurants and stuff have all gone back to 50%. And I'm sure a lot of people are exceeding that. So, but what will come out of that? Would that bring about, more contagion and then causes a second one? That remains to be seen, right? But so far, as long as people wear masks, follow social distancing, there hasn't been a big uptick in the past few weeks. So fingers crossed. So one thing that, I've been attending a lot of meetings. Our partners, we also have weekly meetings just among the asset managers, right? To share information, to talk about, what are the things that we can do. So one thing that I strongly feel is there's going to be a strong fundamental change to the way that people spend money, right? For those of us in the Bay Area, the change that you see around you will probably be more profound, okay? So things like the fact that half of us probably don't have to go back to the office, right? That means, for some of the smaller companies that were originally planning to move into a larger office space, well, it's no longer needed if, most of your employees, if half of your employees can work from home, then the company can continue to expand without having to move into a larger space, right? So with more people working from home, the restaurants and office space, that whole sector gets impacted as well, right? So, these are all the things that we look at to see what sectors will actually do well down the road. Okay, so a few of the things that we saw the most impact is actually with hospitality. So hotels, there's many people around the Bay Area who manage Airbnb that just absolutely got slaughtered. It's like down about 80 to 90%. Restaurants are down about 50%. Didn't go to zero because people were eventually able to start doing DoorDash, or able to do deliveries. But retail, of course, is really, really bad. Okay. So right now the economy is doing fairly okay. Okay. Partly because, the economy is being propped up by the stimulus package. Okay. But once the stimulus package is gone, what kind of impact, going forward remains to be seen. And I'll go into a little bit more detail as well. So right now we have the April's unemployment rate. The unemployment has been going up. It wasn't just the initial rush. It's actually been going up and up and up. So, if you look across the whole United States, right now, Nevada and, basically Chicago, those kind of Great Lakes area got hit the hardest. California, the coastal cities like, Seattle, New York, all have pretty large impact as well. Nevada, of course, whole Nevada is Las Vegas, and nobody's going gambling and nobody's going tourism, during these times. So comparatively, Texas actually did pretty good. In April, the Texas overall unemployment was about 12.8, okay, which is the highest in history. The highest Texas I've ever seen before was about 9.8%. So this goes way beyond that, right? And this was April's data, so May is probably even higher. But it's interesting that Texas actually ended up having a pretty diverse market. So it wasn't just for oil in Houston. Texas is actually very well known for healthcare, logistics, and other type of business as well. So that certainly contributed to diversity and didn't get impacted as much. Okay, so and as I talked about, Texas is going through a phased opening. Restaurants are at 50% right now. Offices, even for normal office buildings, you can go back. Capacity, about 25% capacity. Bars and everything are open as well. So what would the job market recovery look like? So I listened in on many calls and also many different opinions, but most of us agree that we started out at historically low unemployment rates of like barely 3%, right? And now it has shot up to like 13%, getting close to 15%, right? So, but as we reopen the economy, as people start to come out again, the rate at which people go back to restaurants and go back to spending the way they were before, I don't think that's going to happen again. It's not just going to snap back to normal. What we're likely to see is that as the economy opens back up, the people will start going back to work, right? So the unemployment rate would definitely drop, but it won't drop to the historical levels, right? There's a lot of restaurants or a lot of business that's gonna try to open back up and see how things are. And more likely than not, even though they open back up, they'll find that they still don't have 100% of the patronage they have before. And they will still end up, so, some stores and some businesses are just not gonna make it through this downturn. So while the job market will recover, I do kind of expect that, we'll see a bounce in the employment rate where, after it dips tremendously, it'll actually trend up a little bit more and for the economy to stabilize before eventually more and more employment returns to normal. So it may actually take a while. Couple that with the fact that one of the reasons that our economy is doing fairly well is because of all the stimulus that people are getting, right? So part of the CARES Act included the unemployment benefit, which is extra $600 per week if you are on unemployment benefits, right? So for a lot of the people who are making minimum wage or, this $600 a week, which is like $2,400 a month, is probably, couple that with their unemployment, it actually ends up, they're actually making more than when they were still employed, right? So they're not particularly eager to go back to work, especially, they're actually collecting more money than they did before. So, yeah, I don't think it's going to be like a light switch where, the stores are off, and then you just turn it back on and all the employment goes back to normal. It's not going to be like that. You know, some stores just have permanently closed, right? So the 10-year treasury. The 10-year treasury is a pretty good indication of where the commercial mortgage rates trend. Basically, the commercial mortgage rates is usually like about 2.3% above wherever the treasury rate is. You know, that's a general trend. So, you know, if you think about for people that have been investing, right, you're basically getting nothing, putting your money in the bank, or, you know, if you see the stock market as such a risky place to invest, you pull your money out. Those people usually move the funds over to something like bonds or treasury bonds, right? But the yields that you're getting at the 10-year treasury is just abysmal. So there's actually a ton of cash sitting on the sideline, just looking for better investments that's not so risky that they can park their money into. Okay, so with the 10-year treasury rate being so low, and then if you look at the cap rate of current investment properties, it's at about 5%, 6%. You know, you can still get, you know, 5 or 6% cash on cash return on some of these projects. You know, people don't really want to put their money into treasury. People want to invest and make the money work for them. So when there's such a large gap, such a large gap between the 10-year treasury rate and the actual cap rate, it's driving people to invest in commercial properties, etc. And but there's a reason that is being held up right now, and in the next few slides you can see. But primarily it's because of the financing market. The lenders are being extra cautious. They're not really lending out the money as much because they don't want to get in a situation where the people who have borrowed the money won't be able to pay it back and default on the loans, right? So the stock market has recovered pretty strongly from where we first initial dropped off in March, but it's still underperforming compared to you know, some of the more stable assets like multifamily and self-storage. Okay, so this is a snapshot of kind of, you know, you know, how bad things got, how bad things got in different sectors, right? So, you know, with the malls closed, the clothing stores are absolutely non-essential, and, you know, so year over year, they lost about 90% of the business. Furniture, appliance stores, you know, like 65% drop. Sporting goods, all these are non-essentials, right? Restaurants drop about 50%. Gas station, not many people are traveling anymore. So yeah, they got hit pretty bad. So the one bright spot out of all the retail is grocery stores. Grocery stores and big box home improvement stores like Home Depot and Lowe's, right? They continue to do extremely well during this downturn. In fact, I think I was reading the Lowe's financial report. They actually outperformed last year. So go figure. During this downturn, my wife also started getting interested in gardening, and then I went to buy some potting soil and all that kind of stuff. And it was like a zoo. Oh my God, you know, there are just so many people at the big box stores. So in terms of like the different sectors, commercial sectors, shopping center definitely got hit the worst. A lot of renters decided to just quit the business and stop paying rent, right? So was only able to collect 46% of rent there. Healthcare continued in business. Office, you know, these tend to be longer leases, so, you know, they're still paying rent, with some small businesses really dropping out. Apartments across the nation did extremely well. So compared to pre-shutdown time, it's averaging about 93% in collections. So Class A have been seeing about 94% collections on average. Class B is about 93. Class C is about anywhere from 90 to 92%. So, but they're really not that far off. Seriously, if you back in March, when this started, and then if you told me that we can get like over 90% collections, I would be like ecstatic. But like we discussed before, like why, for example, why I chose apartment is because when you lose everything else, you don't have a job, you don't have a house. I mean, yeah, you don't have a house, you don't have your car, you still need a place to live. And the lowest denominator is apartments. So, and people don't want to be forced to move when the times are bad, right? Especially with COVID going on. You just don't want to be moving out. So what we saw is very low turnover during this time, and people pay. People really pay the rent because they do not want to be kicked out. The industrial sector actually did extremely well too. These tends to be large companies with very long leases. And there's expectation that, when the economy comes back, their business will also be back. So yeah, industrial has actually been performing really well. Any questions so far? Cool. So this is a snapshot of April. So we're tracking this like almost daily on how apartment collections are doing across the United States and also in Dallas proper, right? It's been extremely resilient. As you can see, Sacramento was able to collect very high, 96.5% of the income compared to pre-shutdown. Okay, and compared to year over year, Sacramento also saw very strong rent growth. So this is partly reflected in that. This is a comparison versus the same time last year. So Dallas, okay, about 94-95% collections. So all pretty good. New York kind of fell off. It actually wasn't doing that well, and which is surprising, but yeah, things have been really challenging there. Las Vegas, also very challenging. In fact, recently, on the recent data that I've seen, Las Vegas, the default rate is just climbing and climbing. Yeah, as people run out of funds, etc. So, in terms of industry impact, what are some of the hardest hit and what are some of the ones that stay relatively stable, right? So hospitality, hotels, occupancy is down 90%. It's not at 90% occupancy. It is like 10%, 15% occupancy. It is just abysmal. So next time somebody tells me like, hey, let's invest this hotel, I'll just show them the charts that we got. Short-term rentals, Airbnb didn't do well. A lot of people are, the good thing about Airbnb is you have the option of converting that to a long-term rental to ease the pain a little bit. So a lot of people are doing that. Some of the people, because it's not making money and they're very dependent on the cash flow that it brings, they're kind of forced to sell some of these units. Retail and restaurants are not doing good. Senior housing, as you know, senior housing has been hit extremely bad by because the coronavirus just spreads really easily amongst the seniors who don't have as good of a health and they're in such close proximity. So senior housing has been struggling. Student housing, it's kind of a hit and miss. Right now, the renewal rates for student housing is not looking too bad, but for a minute there, in fact, we still don't know. Student housing may actually be a lot worse. The reason is there's a lot of universities and other campuses that are considering doing online for fall session. So if that is the case, then the students don't really want to sign new leases in summer if they're not going to go back to school until like next January, right? So why pay for 6 months of student housing when you're still going to be at home taking online courses, etc.? So that's a huge risk, right? because unlike residential multifamily, student housing, if you don't get them signed and renewed by like September, by August, there's a long period where there's just nothing else is coming in until half a year later, right? So that's a large gap. And yeah, so student housing renewal numbers are being watched very carefully. It's kind of tracking slower, but it's not a complete disaster, but it's just very risky right now. You can't really compare the previous year to the current performance because so much of this style of teaching have evolved. So single family short-term flips and wholesaling has from the people that I talked to who's doing this, this has impacted them a lot. In fact, this impact started last year. So for short-term flips, one of the primary thing is you need to get it done quickly and get it sold quickly. Every month that you haven't sold the property, that's another mortgage payment that you're making, right? That's another utility payment that you're making. So time is of the essence, right? But right now, the real estate market has really slowed down. There's not many people out there looking at homes. Foot traffic is down, so it's taking much longer to sell these flips. And so some of them are going upside down. And really over the past year, there's been a lot of pain in these investments. So least impacted in this coronavirus, so grocery and home improvement stores because they're deemed essential business. This is very different than 07 and 08, where the downturn is felt more broadly and evenly across the whole economy. In this one, COVID-induced downturn, it's more of a, there's winners and losers, right? However, two other sectors always do well in a downturn. One is self-storage, right? So as people downscale, as they are forced to move out of expensive homes, they put their stuff in self-storage, right? So my self-storage business, the one I invested in, as well as other people I talked to, the self-storages are pretty much all full, okay? And they're able to raise the rent and everything because the demand for self-storage is really high right now. In terms of multifamily apartments, collections have been great. Occupancy basically stayed stable. Nobody's really moving. Nobody's really looking for new places. And collections have been really well, right? Online retail, you'll start to see, this is part of the part where I say that you'll see a fundamental shift in the way people spend, right? If you think about like, what have you been doing the past, 2 months? You're probably ordering from Amazon a lot. You're, when you get tired of cooking, you're probably ordering out, but having them delivered, right? So a lot of this has changed. In fact, one of my favorite Chinese restaurants has completely shifted his business from, in-store dining to basically doing online delivery for bulk items, right? So he's doing like lunch boxes by like 300s of them during lunch, right? He's able to develop a new platform for doing his own deliveries. So some people are able to transform and expand their business, so you had to shift with the way the market is going. So online retail is definitely here to stay. People are so much more comfortable now with online shopping, and so that would be a good industry. So before I start going into depth about multifamily, anybody have any questions up to this point? Feel free to also put it in the comments, and then we can answer them as we come along. So what is the impact to the multifamily syndications, right? So, in times like these, it's all about cash, cash, cash. Do you have enough cash to survive the storm, right? it is critical that people start their syndications with a healthy reserve. Okay, um, you definitely want to be able to have enough to pay for at least 2 months. Right now, the consensus is 1 month, but at least I would feel only comfortable with at least 2 months, assuming that you have no income whatsoever. Okay, that you can still survive and still make your mortgage payments, still your insurance payments, and all that kind of stuff. So, as I look across all the different deals, all the different syndications, um, the people who are doing well are the ones who actually have a healthy reserve. The people who don't have it are asking for forbearance, they're asking for bridge loans, they're asking investors for more money, etc. Right? So yeah. So in multifamily, there's different ways that we do business. There's actually usually 3 ways. So one is cash flow focus, where you're basically buying a fairly new property, it's in great shape, everything's done, and when you take over, there's cash flow already. There's not much for you to renovate. Of course, the return is lower, but you have a pretty stable cash flow, right? The other extreme is value add, right? You buy a really old place, you spend 2 years of just gutting the place, right? You're spending $10,000 a door, trying to renovate everything, take 2 years, and then occupancy is probably going to drop down to something like 60% or even to 50%. Your hope is that and because the property is in such bad shape and it's not generating money, no bank is going to loan to you, right? So you're going to have to get a bridge loan, 2-year bridge loan, finish all your renovation, and then try to refinance after 2 years. Well, the trouble is, when you run into a market like this where lending is extremely tight, you can't refinance into a Fannie Mae or Freddie Mac loan. They just won't take it, right? So, and your loan that's 1 year or 2 years is now come due. And so that puts them in a really bad spot. Okay, so projects that are just coming out from from 2 years ago that are just coming out right now, are actually in serious trouble because they can't sell it. There's no market right now. They can't really get a good refinance. Okay, so only experienced syndicators with a good track record are able to get refinancing, but it's at a much lower leverage, and even that they would prefer. So I talk about cash. So you basically want to calculate what is the worst case burn rate, how much cash do I have, and how long can I go, right? And then if you cannot go for very long, you need to start taking drastic measures to preserve your cash. It's all about riding out the storm and coming out ahead on the other end. Okay. Because what you don't want to do, and what I've actually seen quite a few recently, is investor capital call. So, in our syndication investments, right, you put down your initial investments and you rely on us and other leads to manage a property, to manage a business for you, right? And you shouldn't have to put in any more money. The project should be generating cash for you. The last thing that you want is during a downturn, maybe you lost your job, maybe something happened to your income stream. You don't want to be forced to put in money into your investment, right? Your investment should be paying you. You shouldn't have to be in a case where I don't have money and I have this thing I had to give like 1,000, 2,000, or a capital call I had to put in another $50,000. That's just terrible. You never want to do that to investors. So we tend to be extremely conservative in our investments, and we try to hoard cash right now, and then once the economy stabilizes, that's when we can really go out and distribute everything that we have accumulated this far, right? But it is really more prudent to make sure that the business can survive on its own. Let me just take a look Have I traveled to Dallas recently? So no, I haven't traveled to Dallas recently, but we're having virtual meetings like every other day. So and I hear everything about what's going on in Dallas. But I'm probably planning to I do plan to go to Dallas probably next month, sometime in June. It's been a while, and things have calmed down a lot. So yeah, probably next month. Do we have our own construction team? No, we don't. So basically, for the apartments that we acquire, we have our own staff on site. So the general rule of thumb is for every 100 units, you should have one leasing agent in the office and one maintenance guy on the apartment, working on repairs and, just doing general maintenance, right? So we have two in the office. For one of our properties, we have two in the office and two maintenance staff. On another property, we have two in the office and three maintenance staff. So the nice thing about apartments is, when a toilet breaks, right? You're not paying a contractor to come out to take a look and then to fix it for you, right? Just for them to drive out is probably $150. So we have our full-time maintenance staff who, as soon as something breaks and the tenant puts in the work order, he just goes and then he fixes it right away. Our maintenance guys are actually also very experienced. They're licensed in electrical, in pool chemicals, and also AC. So usually when there's any kind of plumbing problem or electrical problem, our guys can fix it without having to hire an outside contractor. So that saves a lot of money, and it makes the tenant very happy because the turnaround time is pretty fast. Okay. I haven't forgotten about Dan. I'll cover this right now. So what are some of the big changes that came out of this COVID? One of the major change is these agency loans. So when I say agency loans, we get loans directly from Fannie Mae and Freddie Mac. It's not like residential where you get a bank loan and then they sell it to Fannie or Freddie. Fannie and Freddie has commercial arms that deal directly with large commercial investments like us. So, due to the CARES Act, Fannie and Freddie are overseen by the government right now. So when Congress pushed out the CARES Act, they also put out, as part of the CARES Act, they have actually pushed other limitations to try to help the people during this downturn. So part of that is actually eviction and late fee memorandums. So basically, starting about April timeframe, it used to be that evictions, etc., memorandums were city by city, right? You could try to file eviction, but the courts are actually closed. You can't really file it anyways. But the expectation is once the courts open back up, you can evict the people. However, for commercial assets that has a loan from a government, like Fannie Mae or Freddie Mac, there's additional restrictions placed on us, which is for 3 months, you're not allowed to evict anybody. So they're trying to protect people who may have lost jobs, who during this downturn may not have a place to go. So as you can imagine, this plays a huge risk on us because there could be tenants that take advantage of this and decides that, hey, you can't evict me, so I'm just not going to pay, right? So, and also you're not allowed to charge late fees. In addition to the eviction memorandum, even if they're convicted of eviction, you cannot kick them out until a month after that. So basically, you can't evict tenants until in August timeframe, basically. So if you were to take advantage, if you're a tenant, if you were to take advantage of a situation, you can literally live for free until for 4 months. So, that's a risk, right? If your property is doing extremely bad, it's impacted by COVID, and then your tenants cannot pay. You have the option of getting what's called a loan forbearance, which is basically a temporary reprieve so that you don't have to pay your mortgage, right? Sounds great. You should never use it. You should never use it unless you have no other option. The reason is once you're in a loan forbearance, right, it's basically anywhere from 3 months to 12 months, right? During this time, you are not allowed to evict anybody. So if you get a forbearance for 10 months, 12 months, guess what? You can't evict people for 12 months, and tenants know that. That's even worse than not being able to evict people until August. So a loan forbearance, despite what Fannie and Freddie say, it will show up on your record. It does show up as a missing payment. So there are some people who have taken a forbearance thinking that, as they promise, it won't show up, it won't be held against you. No, it absolutely shows up. So after a month and a half, we're starting to see on the reports, and people are complaining, and then this impacts their ability to do future deals, right? So doesn't matter what the lenders say. Oh no, we're not going to look at it. Trust me. Next time you try to get a loan, they're going to look at it. So why wouldn't you, right? If you're trying to evaluate, whether this team is trustworthy or not, the lenders are going to look at it. Okay. So you'll be placed on a watch list. When you're on this watch list, they would start watching every month of income. Okay. And then they may actually set up something called a sweep account, where they will force all your rent collection into a lender's escrow account. Okay. And then you're not allowed to touch it. Basically, all the rental income goes into conservatorship, right? And then you had to apply for each transaction, like, oh, I need to pay utilities, I need to pay payroll. You had to ask Fannie Mae, and then Fannie Mae will approve each transaction to disperse the funds to you. Basically, if you go into forbearance, Fannie Mae and Freddie Mac views you as, okay, you're not trustworthy anymore. You don't know what the hell you're doing. Got yourself into this situation. We're going to have to babysit you and watch every transaction on your behalf. So really bad, don't get into a forbearance situation. So for new loans, and this is a huge change, new loans are now much, much harder to get. So they now require what's called a 1-year lockbox. So what the agencies have seen is that there's so much volatility in the economy. They don't know what the labor market is going to look like. They don't know what the rent collection is going to look like. So to be on the safe side, they require a 1-year lockbox. So what's a 1-year lockbox? Basically, when you go and buy a property and get a loan from Fannie Mae, you buy a $10 million property, they're going to require 1 year worth of mortgage, interest, property tax, insurance, all this kind of stuff, right? They're going to require 1 year worth of those payments upfront when you close a loan. Now, that could be a huge amount. That could be like $750,000 to $1 million, okay? Or more locked up, okay? So this will be in an escrow in Fannie Mae. You cannot touch that money for a year, okay? Fannie Mae will be paying stuff out of that, but you as the owner, you're not allowed to touch that money. It's locked away. After 1 year, you have to show 2 quarters of profitability before that lockbox opens up and you're able to access the funds in there. Okay, so it's really, really painful. It's a lot of extra equity that you have to raise when you do a deal. And that extra amount of money that you raise will dilute everybody's returns. Okay, so that makes it, much more challenging to do deals right now. It's put basically a hard stop on a lot of transactions. On top of that, to be conservative, Fannie Mae and Freddie Mac are also reducing leverage. Where we used to be able to get 80%, 75% leverage, right now it's more like 70% leverage or 65% leverage. Okay, you used to be able to get like anywhere from 3 to 5 years of interest only. Right now it's only 1 year. So overall, you can see, it's gonna have an impact on the overall returns, right? The more money, the less money you can borrow, the more money that you have put down in order to earn the same down return, right? So returns are getting less. So it's really putting the brakes on the market. So usually these especially Fannie Mae, leave it to the local lenders. So they have what's called DUS lenders. Those are their trusted delegated lenders that can write loans on their behalf. Now, forget that. Fannie Mae wants to review every single loan themselves, and they want to have much more control over how much a loan is given and all that kind of stuff. So, and they will review very closely monthly income all the way until you close the actual transaction. So if there's any hint that due to COVID or something like that, the rental income on the property that you want to buy is dropping, they're going to reduce the loan leverage. Okay, so you're going to have to cough up more cash to complete your transaction. Okay, so Dan was asking me, Dan was asking me one question is, can we refinance right now? The answer is, for the type of loans that we get from agency, we can't refinance because it has a early payment penalty. So, so for these type of loans, when we get a loan that's for 12 years, the rate is locked for 12 years, and it is at 4% or 5%, whatever it is at, right? They go and then they sell this loan to other buyers. Okay, basically they treat it as almost like a CD type of deal, right? So this loan is guaranteed to return 4.5%, 5%. Okay, now if you pay off your mortgage early, then the person that bought that note can no longer get that money. So then it is up to you in the prepayment penalty to make up for that difference, right? And the lower the interest rate is right now, the larger the gap between the current interest and the interest that they were supposed to earn. So let's say you got your loan at 5%, right? And then the current interest rate, was at 4.5%. Then you basically have to pay, to put it simply, you have to pay 12 years worth of 0.5% interest in order to make up for what the bond buyer, the note buyer lost, right? The more years you have into this loan, then the less prepayment penalty you have to pay, right? Because there's not that many years left on that note. So right now, the prepayment penalty is through the roof because the 10-year treasury, if you remember, the 10-year treasury right now is at 0.68, right? It's just, so the gap between the interest rate that people have and what the rate is really, really high. Okay, so which means a very high prepayment penalty. So what people do is then, in order to avoid a prepayment penalty, properties are sold as an assumption. Okay, so you would take over the loan, and then you're able to get a separate supplemental loan using the lower interest rate, and that kind of balances out how much, what the original rate of the overall loan ends up being. Okay, hope that answers your question. So we can still do it, but for properties that's only like a year or two old, it doesn't really make sense. For properties that are maybe halfway, okay, through it, or even sometimes when you have created so much value yeah, you can definitely refinance. So on properties that we own, if we were to refinance, we would be taking out a supplemental loan instead of trying to refinance the original loan. So we would have increased so much value that, let's say we have increased additional $4 million worth of value. We would probably take 3 million of that equity out as a refinance at a very low rate right now, and then we would return the principal back to the investors. So yeah. Okay. Are tenants taking advantage of this? Surprisingly not. That's why we have 92-93% collections. So people don't want to lose their place. In some of the more progressive states like California, there's forums, there's people all talking about like, hey, we should do a rent protest. We don't see that very much in Texas. Texas is very much pro-business, and all the tenants knows that as soon as things open back up, the eviction is going to come rolling, and they don't want to mess with that. Okay. How are the appraisal values these days? Appraisal values, the cap rate is definitely spreading higher, but not nearly as fast as you and I would like. It's still relatively stable, and a lot of these appraisals are still using recent sales. So since there aren't that many sales, the comps are going back to March, February timeframe, right? So it hasn't dropped significantly. Okay. So impact to multifamily deals. So majority of deals during March and April have all been taken off the table, and they were canceled. I think a few of you guys know we were actually in a running. We were in the best and final to acquire a portfolio of assets. It was over 550 units. We were in the best and final. We were about to win it. Would have been a huge payday and everything. But when we saw the COVID, when we saw what was coming down the pipeline for COVID, we decided it's better to protect our investors. And even though we were in the best and final and most likely will win, because we actually know the seller, and Paul Peebles was pushing hard for us. But we ended up, backing out of that deal, and thankfully, we backed out. So what we know is the seller tried for another week or two to try to keep the things rolling with other people, but eventually they pulled the deal as well. So biggest problem is the lending. We get like a 80%, 75% loan, right? So this is huge. This is like one of the most important aspects. And when it becomes that difficult to get financing, when the leverage has been reduced on a $60 million deal, that's a lot, right? So because the buyers have a hard time qualifying for financing, everybody was expecting the rent was going to drop, thus affecting the purchase price. There's just so much uncertainty that over 90% of the deals actually got pulled. So the lot box requirement, that means, it's a extra million or, a few million for you to raise, and, it just wouldn't make sense. So in order to counter this, so the sellers know, right? The sellers know that, hey, things are not looking good. If I don't close the deal right now, I'm going to have trouble selling it later. So for deals that were already under contract, that is already going through closing, in order to save the deals, sellers were actually offering minimum rental income guarantees. So basically, if, when the property was sold, it was making $1 million in income, okay? Let's say it was making $100,000 a month in income, okay? The seller will actually certify that, okay, I will guarantee that in the 3 months after you have purchased a property, it will remain at $100,000 a month. If not, I'll make it up to you for the difference. Okay, they'll pay you the difference, which is really silly because I'll go into another topic because they may be paying you like 30 grand, 40 grand for the rental difference, but because commercial deals are dealt on a multiplier, the difference in sell price is actually more like $600,000, right? So, but the sellers are doing whatever they can to close the deal. So for other sellers, there are many buyers that has come back and tried to retrade the deals and try to ask them, hey, looking at this situation, you're gonna have to lower your valuation, right? But most of the seller hasn't accepted the fact that, hey, the market is lower. We're not gonna get the price that we originally thought, right? Remember, selling an apartment is a good 4-month lead up, right? So they got all this momentum built up and it's hard for them to now sell it at 10% cheaper. They're just not gonna do that. So most of them withdrew their deals, and they're hoping that once this coronavirus is over, they can get to come back to the market and sell and hopefully get about the same valuation. So one of the first things that we did is to look at government assistance programs, right? So CARES Act, everybody knows, for a family of 4 that meets certain income requirements or below certain income requirements, you get up to, $1,200 per person, $500 every child. And so that's up to $3,400 for a family of 4, okay? Unemployment benefits is $600 extra per week. That's just ridiculous. And it will last all the way until July 1st, right? So that's $2,400 extra on top of your unemployment. So people are making more on unemployment than they are working, okay? So, people are paying the rent first, okay? So with this extra money, they're paying the rent first. But eventually this fund will run out July 31st. And, how will people cope with things past that point? I think that's a real question mark. So one of the things that in CARES Act had was a small business SBA payroll protection plan. So payroll protection plan is a program that the government designed to help employers keep paying their employees. So the idea is to keep the employees paid, and then that will continue to drive the economy. It's a great idea. And if you use your funds to pay for payroll, then up to 8 weeks of payroll can be forgiven. Okay, so which is huge, right? And then, so of course you'll see people abusing it and all that kind of stuff. We were able to qualify for it. So, it's not a small amount. Even though we just have 4 people on our payroll, that's equivalent to, about like $30,000 to $35,000 that we can get and forgiven. So there's also, for people needing a larger amount, there's also another SBA EIDL. You can go up to like multiple, more than $1 million, and you can get up to $10,000 forgiven. So we also looked very carefully. We searched everywhere for city and county rental assistance programs. For the city of Arlington, the county of Tarrant County that our properties are in, there are rental assistance programs where they will help pay for, if you qualify, they'll come and inspect your apartment, make sure it's in good working order, it's a qualified place to live, and they'll actually pay up to 3 months of rent. Okay, so for the Tarrant County one in Dallas, once the tenants qualify, they'll pay your May, June, and July all in one shot. It's awesome. So definitely do that. And then there's always local nonprofit, also church groups. Those funding tends to be very tight. It runs out quickly. So most of them have already run out, but we refer all of our tenants to all of these programs so that they can be sure that they can continue to pay the rent and continue to, won't have to feel too stressed about it. So payroll protection plan, that's probably the biggest one. And yeah, so the initial one was so the initial budget that they had was literally gone over a weekend. Okay. And then they had to approve more. It was so successful, they approved more funding for the PPP. And then the second wave, so we made it into the second wave. Okay. So yeah, I think Aziz, I just mentioned that. Yeah, so we did take advantage of PPP on both of our properties, Encore and Arbor. So you'll actually see on the P&L for the next 2 months, the payroll. So what the property management company is doing is, they're holding the money and not really charging us for it, and they'll be so they got the cash in their accounts. They'll be using that to pay for payroll, right? And for the entire 8 weeks. And once the 8 weeks is up, assuming that there shouldn't be any problems with it, but assuming that the loan is qualified to be forgiven, it has to be used for payroll, at least 75% of it, and then that whole amount will then be forgiven. So it, depending on the size of property, that could be $30,000 to $50,000 per property, which is huge. Which is just huge. Okay, so apartment operations. So this is basically what we've been doing and our experience, right? So when we first heard about the COVID and basically the evictions were going to be suspended, we basically modeled for the worst case scenario. Okay, so we modeled for 40% drop in collections. So that means, how long can we survive on 60% income? Okay, so most of our deals are, our break-even point is at about, I would say, 80 to 84% occupancy, and we can lose $100 off our market rent, and we will still be cash flow neutral. That's how profitable apartments are. But so we assume the worst, right? So what happens if we drop to 40%? Drop by 40%, right? So we with a cash reserve that we have, we actually, even with 40% drop in collections, we have a pretty good reserve, and we can continue operations for a year, no problem, even with a 40% drop in collections. So our investors didn't have to worry, about having to. They're not going to see a letter from us about a cash call, capital call, say, hey, you need to invest or we're going to go under or something like that. No, we manage it very conservatively. Not all syndications do that, because bear in mind, if you're keeping $300,000 around and that just reserves, it's just sitting there. It's not earning you money, right? So raising extra funds in the beginning will dilute the overall returns for everybody, because a portion of the money just sitting there, not generating more money, right? So there's some syndications don't keep that much in order to make the numbers look better. We prefer to be conservative and keep a lot in reserve for rainy days, right? So so for us, across the properties, collections in April and May were about 93% compared to March, basically before shelter in place happened, which is really good. 92, 93%, that's awesome. But due to the CARES Act restrictions, we also lost late fees. Also, we can't charge late fees, right? We also have lost other administrative charges. So, and that's usually about 3% of our collections. So if you look at it, we're actually closer to 96% compared to like before the COVID. So yeah, not much drop not much drop. We're actually doing really well. The tenants are paying. We don't see rent strikes. So, but one of the most important thing is you just need to communicate, work with the tenants, just be very communicative. Okay. Let them know that we're here to help them, to support them. And they feel, it's a community, right? And especially everybody's at home, they're going through trouble. So we're trying really hard to take care of our tenants and making sure they're well off, So the properties, our apartment properties actually continue to be cash flow positive and generating profit. I mean, what investment during this time is actually generating profit? I mean, your stocks are not doing well. Your bank CDs is probably barely making anything. So we're able to generate still very healthy cash flow. So. In terms of like different classes, I think I mentioned class A, okay, will collect a little bit better, okay, because a lot of them were able to work from home. Class B, also a little bit better, 93%. Surprisingly, so we were really worried about April, and April came in at about 92, 93. That was awesome. To this month, May is actually better than April. In terms of collections, we actually collected more in May than April. Go figure. So communication is really key with the investors. So we actually switched to a bi-weekly communication with investors, and basically to let them know mid-month how are things going, instead of just because I think everybody is a little bit antsy about like, how are we doing on collections? Are we going to go under? Are we negative? No, we're actually doing pretty good. So safety measures. I don't know if you guys know what this is. So this is actually a ventilator mask. It's actually a normal, like, when you go scuba diving, if you go to like Cozumel or something, and you just go, if you just go, not scuba diving, but basically you're just floating on the surface, right? It's literally just one of those masks modified with a 3D printed head to connect to the ventilator.
Snorkeling. I think he meant to say snorkeling.
Snorkeling. Yeah. It's just a snorkeling mask. And this snorkeling mask is like what, $10? And then somebody actually modified it to become a ventilator mask. Actually pretty cool. So anyways, we took safety very seriously right in the beginning. So we closed the office. Our team is still working. They're still in the office. They go to the office every day at the same work hours, but they answer things by phone call, by emails. We try to do everything online as much as possible, right? However, for certain tenants, they still want to. They like the person-to-person touch, right? So they still want to come in and talk, right? So we allow that by appointment. They basically just stand a good 6 feet away from the desk, and there's a capacity limitation, right? So basically no more than one person per 100 unit at a time in the office, okay? So we ordered masks and sanitizers for the office. So we actually ordered a pretty large shipment from somebody we know in China, and got us a lot of the surgical masks right in the beginning. So that was passed out to the office, as well as the extras were shared with the tenants. So whenever we have work orders that we need to go into a resident's office, a resident's home, we ask that, hey, can you guys stay in your own room, and then we'll come in and then we'll fix a sink, we'll fix your toilet, we'll fix whatever, right? But we're minimizing contact between our working staff and the residents. So yeah, and then they of course go in with a full mask and everything, mask and gloves to do work. Just like you see at the checkout counters, plexiglass for the store clerks. We also install plexiglass for our leasing office staff. So even if they have to talk to a tenant, it's behind. The public facilities for apartments are all closed because you simply cannot observe the social distancing requirements. And we don't have the staff to constantly monitor and enforce it, right? So things like playground, gyms, swimming pools, all these public facilities are closed. In the Dallas-Fort Worth area, they have a requirement of swimming pool. You need to, it's like one person per 13 feet. And then so that's basically like 2 people in the pool or something like that. So forget it. We're planning to close the swimming pool for the entire summer. So until such a time that Texas lifts any social distancing requirement, then we'll open up the pool. But right now, we don't plan to run it at all. Okay. Yeah, anytime any visitor comes in, we wipe down the office with Lysol and stuff. So first and foremost, you got to protect your employees, right? And then you got to protect your tenants. So we've been passing out guidelines on like, hey, how should you guys stay safe, all that kind of stuff. So let me pause. Any questions? You guys have any questions up to this point?
Are you able to raise rent?
So right now, we're not trying to raise rent. So what we're trying to do is we're renewing people at either the market rent, or if their rent was already above market, we're keeping it the same. And then for new people, since we have pretty decent occupancy, if we're willing to pay the higher price, great. But we gave our office leeway to come down a little bit from the market price if needed, but we didn't have to do too many of that. So the main thing is it's really hard to get a tenant in right now. Everybody was sheltered in place. Nobody was coming out to look at apartments, right? The foot traffic dropped by like 90%. Nobody was thinking of moving. People were extending their existing lease, going month to month, because people didn't want to move, right? Didn't want to have to bother with a moving truck. So if you lost tenants during that time, it is really hard for you to get a new tenant, because there's just not that many people looking, right? So we work really hard to retain our existing tenants and trying to capture every single new one that comes in. So because there's nobody coming in through your doors to look at apartments, we had a huge marketing push to increase our online presence, right? So I completely redesigned our property's website. It looks very clean, modern, and some of the most critical things we're going for is being able to show off our property, allow them to apply directly online. Okay, so they don't have to do a phone call. They can just fill out some simple form and then they're able to just apply. Okay. Our residents, should be able to make their payments online, and we had a much higher usage, the online payments. And then they can also submit any work orders they have online. So this is all to reduce traffic. They don't have to come to the office, right? So because we're usually pretty full, we don't really have any model units. So we have pictures of our units that are completely empty. So we actually did a virtual staging. So, for example, like this picture, the chairs, the sofa, the paintings, these are all photoshopped on. Like the sofa, the rug, and TV and stuff. These are all added after the fact, okay? And so we found some people who were able to do it super cheap, something like $20 a picture, and I think the effect turned out pretty well. So And then you just massively go after every place where you have a presence. New photos for Google, apartments.com, Craigslist, we have a new template, everything you just want to, attract people, because people are not walking in, so they're all looking online, right? Majority of our traffic comes from Craigslist and as well as Facebook. So, however, it's not from the Facebook apartments page, but rather we target Hispanic groups and other apartment groups. But because our office staff tend to be Hispanic, so they have these personal groups that they're involved in, and then when they post stuff there, they get a very very large amount of hits from there. So yeah, we also do that in all the other groups, and we do get hits there as well, but for some reason the Hispanic groups are particularly active looking for apartments, and we had good success there. Okay. So on top of all these, it's very important that you control your expenses, right? So right now is the time, at first we thought that we're gonna have an extremely low income, then you got to cut expenses, right? So we're delaying large capital improvements, okay? We are reviewing every single expenditure that's above $700. Okay, so we spend days and we're just constantly reviewing everything. So every large purchase needs to be approved by us, needs to be explained, needs to have a unit number tied to this, right? So if you don't watch your maintenance guy, a lot of times he'll buy like, he'll buy like 50 fans, right? It's like, why did you buy 50 fans? We shouldn't be stocking up right now. It should be, we should be just buying what we need, right? So, so every purchase, every of these material has a unit tied to it. So we can track, okay, is it only for things that we really need? We're not, buying too much excess. So, yeah, there's a word, optimized personnel. The word optimize just means layoff, said nicely. But so we let one maintenance guy go in one of our properties, and instead we switch to using floaters. Okay, so floater is, for a large property management company like Wayner, they usually have like 10 to 15 people on hand that help out at different properties for small projects when needed, right? So instead of having a one permanent helper, we decided to switch to a floater method. And since, if you look at the next line, we are doing emergency repairs only. Okay, we're only doing required, like if the air conditioning or the heater goes down, that's a required one. If there's a leak, that's a required repair. But if you say like your light bulb is broken, hey, or when I close my closet, it's making a squeaking sound. No, we're not repairing those. We're only going for emergencies, right? So since we're only doing emergency repairs, then we really only need one maintenance guy, right? There's not that many stuff. We're not doing capital improvements. We're not renovating units. So you don't really need that many people. Okay. So, and then you can call in a floater whenever the current guy is overwhelmed, right? Then you can call in a floater to help him, offload him. One thing you will note that is the utility bill will jump a lot higher since everybody's staying at home. Okay, so that means 50% higher electricity, 50% higher water, 50% more stuck toilets. That's just a matter of life, So, but we are, our properties, we charge back the utilities, so eventually it all works out. Okay. And then one more thing is because in April and May, we really weren't sure what the rent collection was going to look like. So we had raffle drawings, right? So raffle drawings are fun, like, exciting. And basically, if you pay your rent before the 1st, then you'll be entered into a drawing where we have 2 TVs that we have up for grabs, right? And then if you pay by the 3rd, okay, if you pay by 3rd, then you're entered into a drawing for like a $50 gift certificate or some small tablets, right? The TVs only cost $100 each. I mean, for 2 prizes, it's like $200. It's next to nothing. And then the and then the tablets are like, yeah, $50 or less, right? So for very little money, you can generate a lot of excitement. And just by doing that, we had a huge amount of people pay even before the 1st, right? So I think we got like some 30% of the people to pay before the 1st just to join in on the raffle, right? So what you don't want to do is across the board, hey, we're going to lower your rent, or that kind of stuff, because they're going to want that every month. So raffle drawings, much better. Okay. Any questions regarding the apartment operations? Okay. So basically, it's all about, keeping a close touch. So my job as an asset manager is to be constantly on top of these things, to come up with a plan on, what does our office staff need to do? What does our property management company need to deliver on? So we're managing them like every day, nonstop. It's pretty much a full-time job. So, but daily calls to make sure that, hey, are you getting collections? Are you getting this? Hey, did you go and ask the city for this, right? If there's something that big breaks, we had to check three contractors for fixing chillers, for doing certain things, right? So you just have to stay on top of it, right? So but I like doing it. I don't mind that. Yeah. Am I happy with the new management company? Yes. So I think you're talking about Encore, the Encore property. So yes. So before with the old management company, they used what was called dynamic pricing. So every day the price for a 1-bedroom or 2-bedroom will fluctuate up and down, okay, depending on how much the competitors are pricing their apartments are at, right? So, I mean, that was driving potential tenants nuts, because they would check out the price, go back and talk to their wife, come back, and then now it's like $20 more expensive, and that's just a big turnoff. And plus, they're still smaller. The Valiant was a smaller company compared to Wayner. Wayner manages 27,000 units just in the Dallas and Texas area, right? So, so we didn't really like them. And then once we swapped them out, we brought in a team that we were familiar with from another property, and they turned the property around. I mean, it was basically coming back from like 82% occupancy, and right now it's like about 95% occupancy, which is basically full. So they actually done extremely well. And in terms of our collections, the collections have gone way up as well. So much so that we're able to continue renovations in Encore. So because we have enough cash flow to do it. Okay. So yeah, managing apartments not easy, but just have to really keep an eye on it. During this time, we're also, one of the key is you have to you have to have a good network of people that you work with, right? So not just your property managers, not just your lender, your brokers. You know, for us, for people like us in the business, we have also a ton of friends who also own apartments in different parts, right? So we're constantly, you know, every week we have a call with our lender, James Ng. You know, we have a bi-weekly partnership meeting where all the partners get together and share ideas and talk about the current market. And yeah, that's where a lot of beneficial things come out, right? So like, hey, you know, what is the current property tax? You know, can it be protested? You know, Tarrant County is offering this program for helping, which we didn't know before. So, you know, it's funny, you know, it's a competitive circle where people are competing against each other for deals. But once you win deals, everybody are the best of friends because we're all in it together. We're all managing it, and you know, just helping each other do well. PPP appraisals. Okay, I think that's okay. So looking forward, you know, what does it look like down the road? And you know, so there's a very interesting illustration on the ripple effect. Okay, so you know, we have yet to see the full ripple effect of this COVID-19. So what this chart is basically talking about is you have the origin event, COVID, right, which has a impact and causes unemployment, right? And as a response to the unemployment, you know, the government stimulus is now coming, right, as in response to try to slow it down, try to stabilize the economy, right? But that can only happen for so long. If we don't get back to a more normalized economy, if we don't come back right away, you'll start to see defaults, okay? The financial crutch that we're on will be gone eventually. And then, yeah, so if the economy hasn't come back at that time, you'll start to see the defaults happening, okay? After the defaults, okay, in fact, right now, in commercial CMBS, which is another type of loan that you can get, the default rate is as high as 25%. Okay, those are for people who can't qualify for the high quality Fannie Mae or Freddie Mac loans, right? So they go for something called CMBS, commercial mortgage-backed security. But the default rate there is getting higher, right? So after people start defaulting, the bank is going to be, you know, starting to take the properties back. Okay. And, you know, that's kind of a good timing to start considering, you know, should you be buying, should you be doing whatever. Based on what I've seen, the sellers have not been dropping their price yet. They're not convinced yet. Okay. So the properties would have to sit for a while for them to feel the pain and eventually want to sell. But I can also see the fact that because apartments are actually doing so well, they're not in a hurry to sell. They can just keep holding it and keep cash flowing, right? They have no urgency to sell. So, you know, there could be deals here and there, but in the multifamily sector, probably not that much, right? Probably not that much, because the collections have been so good, right? So, so you know, the way that we kind of look at it is with the downturn, that the initial downturn that we saw, right, was lessened by the stimulus. As the stimulus runs out, as summer finishes, and then people start going back to work, we may see a second wave of pandemic, especially with people rioting, giving it to each other in close proximity. We might actually see a second wave of pandemic, let's say in the second half of a year, right? What does that impact is? Really hard to tell. maybe the US will end up printing even more money to keep holding the economy up. But you keep doing that, you're gonna get another ripple, which is hyperinflation, right? You just print so much money that inflation starts getting out of control. So right now, when we look at what kind of assets that we want to acquire, we kind of look back at what type of assets were really good during downturn. So I'm a pretty conservative investor, right? So it's always make sure you don't lose money. Second one, make sure you don't lose money, right? Third one, make sure you look at the first rule, don't lose money. But that's not saying you will never lose money, but you try to go for things where you're willing to accept a smaller but safer return rather than a large risky one, right? So as we've seen in this cycle, the ones where try to do short-term flip, try to do a 2-year flip and then a refinance, they got really screwed because there's nobody buying and they can't refinance because of the qualifications needed, because of the lender stopped lending, right? What happens if the lender stop lending and you have a bridge loan that's coming due? Do you want to be stuck in that situation, right? So, we tend to stick to properties that do well in a downturn, right? And there's a mantra, if it isn't cash flowing, if it doesn't cash flow, let the grass grow. Just let it go. If you think about it, properties that at least have some cash flow, will that's your buffer. Okay, so in a downturn, that is your buffer. Okay, you can drop, so right now our properties are still cash flowing 5%. We can drop another 5% and still be neutral, right? That is your buffer built in. So it's super critical. Let me plug this in. Yeah, so the type of properties that we invest in is has both a cash flow component as well as the value add, right? So we buy, since day one as we acquire it, it's already cash flowing, and then there's also equity gains at the end because we're improving the property, we're able to charge higher rent for our newly renovated units. So yeah. So we talked about the federal assistance. So right now, as we're looking for new deals, we're being very conservative about rent growth, okay? So right now, it's probably, you don't want to be writing for any rent growth. For the next year, probably 0%. For the second year, maybe 1%. If you're gonna be investing in deals, take a hard look at those numbers because it's really hard to project any rent growth right now. Okay, so we're definitely continuing to look at deals, but we're so we're being very cautious. Okay, so if there's a really attractive deal that the seller's desperate to sell, we'll definitely go for it, right? But a lot of these deals, because the sellers haven't adjusted their attitude or their expectations, it's not quite matching up to where we would put our money. Okay, but be prepared because, like I said, in the very beginning, we're earning nothing for our cash right now, and multifamily type of deals is continuing to earn money even in down market. So yeah. Okay, so now I'd like to open up to everybody. Feel free to ask any questions you want. Okay, guess we're all good. Oh. Are there new markets to enter that you wouldn't have thought of before? That's a good question. So one thing is, we have been exploring new territories. Okay, so this is actually a pretty good time to start getting in touch with brokers from different markets. There's, we've been setting up a lot of time. Just, I've been chatting with all my broker friends, and we're just talking about general markets. And this is a good time to do a lot of research, learn about like places like Atlanta, Florida is hot, Arizona is hot, and all these kind of stuff, right? So places that we didn't want to spend the time to look at, now, with everybody at home, everybody have more free time, take this opportunity, check it out, right? In terms of like, right now, new construction is just not looking good. So for example, it's really new construction is all about absorption rate. Okay, so the way new construction works is you get a bunch of money. For the first 3 years, you have no returns, right? Because they're building the buildings, right? As soon as the building is built, they will give very, very cheap rents to fill the property up to 100% or 80%, 90%, right? And then they try to sell the property to the next guy. You're selling the dream that, hey, you're going to be able to fill it up to 100 and you'll be able to charge market rent, right? So but right now it's very hard to find tenants. And like I was saying, if the economy continues to not be good, you'll find that people are not going to be renting the Class A expensive stuff. They're going to be moving down to B, right? So that may actually be an opportunity. As people move out of Class A, as the occupancy drop and they can't demand that much money, it's actually quite possible for you to pick up a nice Class A asset at a severe discount. And that's something that we've been looking at. So the nice thing is it will be a cash flowing property. It'll be something that you can hold on for a longer term. There's a mix. Everybody have different goals, and some people want like a quick flip, get the money out. Some people want to hold on to it as a steady cash flow. So we would like to offer both options. So depending on the timing of the market, it could make sense. Okay. So cool. Thank you guys for coming. It's a lot of fun. Maybe we'll do this more often. And yeah, so feel free to email us. Any questions, feel free to contact us. Always available for chatting, especially now. Cool. Okay. Thank you guys. See ya.
Thank you very much, Tony and David. Thank you.